Hello students, welcome back to IBS. Today we are going to discuss about balance sheet overview part 2. Part 1 we have discussed a lot of things with regard to balance sheet. So now we are going to learn more about the balance sheet. So let's jump to the topic. We are going to learn about current liability, as we already discussed about the definition, something which can be kind of obligation which we can pay within 12 months. So that will be our current liability, and how we will pay through our current asset. So that is the basic definition of current liability. We have obligation. That obligation has to be settled through current asset within the time frame of 12 months or operating cycle, whichever is high. Now there are few examples of current liability. I am trying to give all the item which is available in liability, so that when you are creating any chart of account for your company, if you are working as an finance director or something, so that will be quite helpful to you. You will not be confused with regard to where to place the item. So whatever I'm trying to teach you, try to get the information as much possible. We'll understand about the accounts payable. Accounts payable due to supplier for goods or service. That is first of all informal. It is not a written document, and that too for shorter period of time, for 30 days or something. For example point of view, utility, water kind of bills are considered under accounts payable. There is difference between accounts payable and trade notes payable. Trades are normally formal. When you agree to pay him, like promissory note, you have to document, written document, that I will pay you in particular date and how much amount. That is why this is formal, and if you will not pay, you have to bear the interest if you are going beyond the date of payment. So this all the kind of stuff are mentioned in the trade notes payable. Trade notes payable is like your normal business, whatever your business is. For that you must have some regular supplier or vendor with whom you are dealing with on a regular basis. For that you will create contract, and these are recurring kind of nature of invoices and other stuff when you are purchasing for one time or something. So for those there may not be formal written document kind of stuff and term and condition and all. Still, if you create a non-PO invoice or PO based invoice, so that time there is term and condition. If it is not there, still they will be considered as an accounts payable. For example, if you are going to restaurant and you are eating something, so you know you have to pay based on their rate. This is not formal, you have not made any contract or something, but still their contract is exist, because you know you are going to pay based on their rate what they are showing you in their list of item with amount kind of stuff. Similarly, but in trade and notes payable, you will actually make contract based on that agreement, term and condition and negotiation. Everything has been decided for your raw material or your material or whatever you are service you are taking. So these are the difference between accounts payable and trade notes payable. Okay, now we want to discuss about dividend payable. Dividend is basically paid to company owners and the person who has the share of that particular company. How dividend is being declared? Normally you need to debit the retained earning and credit the dividend payable for whatever amount it is. So now it is called dividend has been declared for particular date. You also decide when you are going to pay. So till then, whatever the period in between, that time it will be available in your current liability as a declared dividend and in dividend payable account. So dividend payable account are all normally in current liability section of your balance sheet. So when you will pay, that time you will be dividend payable, you will debit and you will credit the cash or bank, whatever it is, like this. So we are debiting the retained earning. Normally when you debit retained earning is also your equity part, so then it will reduce your equity value. Whenever we pay dividend, it will reduce the equity value. We will come into this kind of stuff later in detail. So now we will discuss about unearned revenue. It's simply meaning you have received cash, so you will debit your cash for X amount. You have received cash, but you have not provided any service. So service we need to provide. So that is why that will be going to your liability section. Unearned revenue. Cash is your current asset, unearned is your current liability. So similar amount you are debiting, crediting. So ultimate impact on your balance sheet would be nil, but you are recognizing cash. Since you have received cash, for that purpose we are also recognizing liability, because we need to deliver the service. As per revenue recognition principle, you will only recognize revenue when you deliver the service. And I will deliver the service or goods. At that time what I will do, I will debit the unearned revenue and then I will credit the revenue. So now this amount will go to your income statement, the credit side in the revenue part. Now it has been traveled from your unearned has been nullified, and your balance from balance sheet liability section it has moved to income statement. So this is how this flow is working. Let me explain. Balance sheet, current asset, current liability. This is your income statement. Revenue, the revenue has increased. Earlier what you did, you have increased your current asset as well as you have increased your current liability. Make it this side, current liability you have increased, so ultimate impact was nil. But later on you have reduced this by similar amount, so now you are having this amount here and contra amount is available here. Now you have reduced here and you have added here. So this is how it has been traveled here. And the point here is, for that service or something you incurred some kind of inventory also, that also will be in your current asset, that will also reduce for the minimum lesser than this value. So that amount will be reduced, and again that amount will be added here. This one is your minus entry. Revenue are in minus, and cost of goods would be your positive entry, that will be coming here the similar amount. So this part also will be balance sheet, and this part will come into your income statement. So ultimate net profit you will get at the end. So this is how the cycle normally works. I will keep on telling you how normally this kind of function works, so you will have good idea with regard to transaction, how transactions are following from where to where. It will give you good idea with regard to, you will develop your mindset how things are working when you are going to implement some kind of software and ERP system. That time you will be having good knowledge how things are following. You can be a good kind of functional consultant who can support company for implementation kind of stuff. I think we are clear with regard to unearned revenue. Now we will learn about the agency. This is something for tax related agency. They ask for their payment, we need to book those kind of expenses, and then we will also book the accounts payable or accrued expense for this kind of taxes, maybe TDS, maybe VAT, maybe GST, and then we will pay them. So till we have not paid, that time it will be in your current liability. And demand notes are obligation due on demand, kind of promissory note. This is kind of financial instrument, a short term loan. This is the example for your demand notes. This is short term loan we company take to pay within 30 days or something, so that they can manage their cash inflow and cash outflow to maintain. If anything is required in emergency, that time they are taking demand notes kind of stuff. Short term notes and trade notes payable, you should keep in mind, this is for formal document, and that too between legal supplier or vendor. You have a written contract or something, amount and time and interest, if in case of delay, everything is mentioned. This is for business purpose, and this is short term notes is financial instrument kind of stuff, and that notes with maturity of 30 days, 60 days and 90 days. So short term notes also carry kind of interest you have to bear, and company takes for to meet their cash related issue, and that is also a formal agreement to be made, in which interest percentage also been decided. For example, when you issue a short-term notes, then what kind of entry or general voucher entry you will pass? You will simply debit your cash you will receive, and then you will book your liability, credit your short-term notes for maybe 10,000. And then when you are going to pay your short-term interest, that time what you will do? You will debit your short-term note, and you will also debit your expense, interest expense, that will go to your P&L or income statement. This is 10,000, this may be 500, and you will credit the cash, that cash you are paying. This one will nullify with this, and this expense will go to your P&L, and this cash will be nullified with cash. Just that you have taken 10,000, but you are paying 10,500 because of interest expense. This is the overall impact. We have explained enough. Now we will learn about the current portion of long-term debt. By name suggest this is long-term. Suppose you have long-term debt is somewhere around 1 lakh. Out of 1000k, 10,000k you need to pay this year within 12 months. So that portion will come into from long-term debt to your current liability section. Either you pass one reclassification entry like debit your long-term debt for 10,000, and you can credit your current liability for 10,000. This is how you can pass a reclassification entry. Now it is your current liability section. It is coming. Earlier it was in your long-term debt. So that is why that will be considered as a current portion of long-term debt. Principal payment due within current period. This is due in this year, but overall it is due. That will be not due immediately or currently. So that is why that will be in your long-term debt. Now tax payable, wages payable, other accrual, these are the accrued expense and taxes. Accrued expense are for that suppose you have consumed benefit, since as per revenue recognition principle or expense recognition related principle, whenever you incurred any expenses that you have to recognize in your P&L or income statement. So that is why, since you have already consumed benefit, for example, you ask your employee or labor to give you the service, so 30 days he has given service, so at 30th day you have booked the entry salary expense or wages payable expense will go to your income statement, and to salary payable, it will be in your current liability section of your balance sheet. So now you have created your due or obligation that you will pay. How will you pay? You will salary payable, you will debit, and then you will credit the cash or bank, whatever it is. Your asset will go and your current liability will also be removed. So this is how it normally works. And one more thing I would like to clarify with regard to accrued expense and accrued liability. Accrued expense specifically refer to cost or expense that have been incurred but not yet paid. Similar case will be here, but that is not talking about expense only. That is talking about all kind of obligation, whatever obligation. So obligation for accrued expense may be your utility, water, interest, all kind of expense will come, wages, salary, all. But apart from this, also your obligation would be like tax payable. This is a kind of expense which is not your operational or business related expense. This is expense because you have generated some net profit. For that net profit you have to pay. That is the obligation from external. This obligation from external, from government. So even government related obligation or any other obligation, short term, all kind of obligation plus expense including both will be considered under accrued liability. But accrued expense is only the liability which is related to your P&L income statement first of all, and that is expense part only. If it is anything other than expense, that will come into your accrued liability, and even expense will also come into your accrued liability. So this is broader term. This is kind of little bit shorter term compared to accrued liability. I hope it is detailed explanation with regard to accrued liability and accrued expense. So let's jump to the another topic. Now we will learn about the callable long term obligation. This is little bit difficult. Let's assume you are a company A and you issue this debt instrument, and your buyer is buying from either person or individual, whoever. So he is buying you, so he is paying you. Okay, suppose you issue for 10 million bond. For that you will receive cash for 10 million, and then you will be having callable long term obligation in your current liability, though it is for long term, more than 12 months, maybe 5 year, 10 year. But since it has callable option, if you have suppose current asset by current liability, they are expecting at least you should maintain 0.8 ratio. If it is going beyond that, if it is coming like current asset versus current liability fall into 0.75, or they have any other than this, there is any other term and condition, if you are agreed with this based on the agreement when you are issuing your debt, that time if you are violating anything, he can call the option, and then you have to pay him the cash back including interest. When he is calling, he will not be defaulter because you are violating the agreement, so you will have to pay interest also. In case if you are paying him for that another kind of bond, and that time whatever, if you are not defaulter and you are paying because of some other reason, and when you are not defaulter, so that time you may not be needed to pay interest as decided or based on the new term and condition. In case of defaulter is your buyer, that time maybe you have to reduce your interest. But since it has option to call anytime whenever you are violating, and when they see that market is giving interest which is higher than what you are giving into this bond, long term obligation bond, so that again if they have option to call and they can execute their option, so you have to pay him. So anytime you have to pay, that is why this will remain in your current liability. Now we'll see some of entry related to this. So now we can see what kind of entry we pass. when we issue long-term obligation, okay, callable. So this is a kind of financial instrument which is being called as a bond, we can say. So initially when we are recognizing, that time we will debit our cash because we will receiving cash, and we are creating our obligation for similar amount. Apart from this second entry, what we will pass, we will book our interest we are going to pay. So interest expense will go to your P&L or income statement, and cash when you will pay, or you can also create obligation. It is purely depend on the how you are going to account those entry. So based on your accounting or IFRS and US GAAP, you have to account your entry, but the point here is interest you have to pay based on the term and condition whatever you have agreeing to pay what interest for whatever the loan is. So maybe for example you have interest of 5% or something, so you need to book 50,000 as in you need to pay for 10 million. And when the person who has buy this and he paid you 10 million, so if he found some violation or something and he used his callable option, so that time you have to pay him. So for that, what entry you will pay, you will debit your bonds payable for 10 million and you will book the loss for bond sale, okay, that amount. Then you have to credit your cash for the similar, including these two would be debit entry, this one, and this will be your credit entry. So your bonds payable will nullify with this, and then your bond payable will be zero, and your ultimate impact would be cash. Whatever you have cash received, now you have paid the cash, so the interest part will be your excess amount which you need to pay. Since you have violated this, so you may need to pay extra. If you have not violated and he still have callable option, in those cases maybe you have 5%, and if you have not violated any policy and he is asking for payment and based on term and condition, that time you will pay 2% or something based on the period. If it is 12 month completed and now you are supposed to pay 5%, but since he has break the policy and he want full money including interest, so that time whatever the term condition you will deduct that percentage, maybe 5 instead of 5 you need to pay 2%, then 20,000 you will pay only, and then 10 million you have to pay. So 10 million and 20,000 only you will pay. Otherwise if it will be keep going on, then you have to pay 50,000 only. 10 million you will no need to pay, you will have to keep it in your bank unless they call for the option. So or maybe the maturity would be 5 year or 3 year, at that time you need to pay entire amount. So this is how this is working. Let me understand few things with regards to exclusion not considered under current liability, like non-current death. Anything which is non-current long-term death, obviously it will not be the part of your current liability. And refinance anything from your long-term death, maybe 10 million. Out of 10 million, 1 million you need to pay this year, current year. So you have to reclass this, as I told you, debit your long-term debt for 1 million and credit your current liability. Likewise, you are recognizing your current liability. Your current liability will increase, which you need to pay through cash. Then you will do the current liability, you will debit, and cash you will credit. This is how your liability will be removed. Cash will be credited. It means you are losing your cash. This is overall the process. But in what situation we will book refinance the obligation for the similar thing? Long-term debt is about to be paid current as in current liability this year. But what we did, we have spoken to our bank or wherever we have this due whom we need to pay, and he has given a refinance option. So if we have refinanced it for more than 12 months or something, so then again it will switch back to long-term liability. So that is why that portion will not be considered as an in current liability, because it has been refinanced and maybe you need to pay some refinance fees, that will be your expense. But liability point of view, that will be your long-term liability, not short-term obligation. Let's read it out. Short-term obligation intended to be refinanced for long-term. Long-term you need to refinance, and provided ability to refinance is demonstrated. If it has been executed something, so then it will not be considered under your current liability. This one also, if it is not refinance, if you are not able to refinance, you have to keep into your current liability, like this current portion of long term. If you are able to refinance it, then again you have to move back to your long term liability. I think it is clear to you. Now key point is current liability are short term obligation. Current liability is always short term, expected to be settled within either operating cycle or 1 year, whichever is high. This is overall the explanation of current liability. Thanks for watching. See you into the next session. Stay tuned.